But I think aside from oil kind of going up recently, I think the inflation trend is going in the right direction. So I think that's a good sign. It means that the Federal Reserve is probably, at the end of its tightening cycle now, even if they might keep rates higher for longer than people were expecting. I don't think they'll go any higher than they already have. So to me, monetary policy is starting to shift to become less of an issue.
Sam Burns, Chief Strategist at Mill Street Research. It is great to welcome you back on the show and great to see you, Sam. Thank you so much for joining me again.
Oh, my pleasure. Thanks for having me on.
Well, Sam, a lot of folks, they might be coming to the channel for the first time, so they may have missed your episode, which I believe we had you on for episode 56. And you have a really fascinating approach to research, running an independent research shop, Mill Street Research. Can you just walk the folks through real quick before we dive into anything around the economy or the markets, your investment strategy and process?
Yeah, no, that's right. I try to take a kind of a combination approach. I think of it as both top down and bottom up. So I'm looking at the macro view, what the markets are doing, what the economy is doing, but then also looking at a lot of the data that I track for individual companies, looking in particular at what analyst earnings estimates are doing as kind of a measure of what the fundamentals are, how they're changing at the company level, and then looking in industries and sectors as well. So I can kind of get a combined view of what's going on in the overall economy, but also at individual companies and industries based on that kind of mixture of data. And a lot of it is objective indicators, models, things that I've developed over the years, to try to make sure that my own personal biases and kind of emotions don't get in the way, and to really keep it focused on what the data says and not what I'm just kind of reading in the headlines, which I think is a big kind of risk for a lot of investors.
Yeah. Like, as you put it, you have the macro view also combined with looking at the companies more on that individual level. And I think that's a great way just to level set for the conversation for folks. So I am curious what clients are asking you about these days. What are kind of the conversations that are top of mind for you all right now?
Well, right now, yeah, it's really kind of the offsetting effects of interest rates and the Fed versus corporate earnings, and in some ways, it's also monetary policy versus fiscal policy. This cycle has really gotten a lot of clients kind of thrown off base, even than just over the last couple of years, because it's been such a strange cycle post COVID, in that we've had an enormous amount of volatility in the economy and in earnings. And it's now starting to settle down a bit, but you've got the Fed tightening monetary policy aggressively, while at the same time, fiscal policy is actually quite stimulative and supportive. And we really haven't seen that combination for many, many years. And a lot of clients really don't quite know what to do with that, because they're seeing earnings hold up pretty well and the economy hold up well, even though the Fed's raised rates, as aggressively as they ever have. And normally they kind of focus on the Fed. They think, well, if the Fed's raising rates, that's bad, and you should, avoid stocks, and the economy's going to go into recession. But that hasn't happened. And I think it's because fiscal policy and a lot of the kind of secondary effects of COVID have kept that from happening. But that's very unusual. And so a lot of clients are really trying to figure that out and see, how to play that. And so I think a lot of them came into the year too cautious about stocks and about the economy, and have now started to adjust that to see that, well, yeah, actually the economy's holding up pretty well. And even the Fed has had trouble figuring that out. And just last week, they seemed to kind of move in the direction of figuring that out and adjusting their own forecasts.
Yeah, because when I had you back, I think I had you on in February, you were bullish on stocks, and certainly quite the call, if you will. I am hearing more of that macro picture for you. Would you mind just kind of setting the table, if you will, on the macro? What is the macro view for you today, that framework, if you will?
Sure. So at the macro level, I'm seeing, better than expected economic data, that the earnings surprise. The economic surprises have been positive, both in terms of growth, consumer spending, the labor market have all been much stronger than people thought they were going to be at this point. And also inflation has been coming down, as, I kind of anticipated, but that has been going, I guess, better than a lot of people have expected. Even though some of the current year-over-year numbers are still somewhat elevated, I think most of the things that should happen are happening. I think, and part of the reason is that the inflation data is somewhat lagged because of the way they incorporate housing costs, essentially. But I think aside from oil kind of going up recently, I think the inflation trend is going in the right direction. So I think that's a good sign. It means that the Federal Reserve is probably, at the end of its tightening cycle now, even if they might keep rates higher for longer than people were expecting. I don't think they'll go any higher than they already have. So to me, monetary policy is starting to shift to become less of an issue. I think earnings and fiscal policy are really going to be the key factors to watch at a macro level. And even just in the next week, if we have a government shutdown, things like that can affect the economic data and what we're seeing. I think the potential for student loan repayments to pick up again, is another factor that might impact consumer spending. So those are all kind of the big picture macro views that I'm looking at. Also seeing global growth, in Europe or particularly in China, kind of slowing down, not really being a source of growth globally. So again, I don't think the problem is going to be too much growth. I think, as we go into next year, it'll be, too slow a growth. It will be the concern. But right now, I think it's more a balance between, supportive fiscal policy and tight monetary policy.
I want to hear more on the fiscal policy side of things. I guess the balance between the fiscal and the monetary. Can you elaborate a bit more on that?
Sure. So the kind of the simplest way to measure fiscal policy, in my view, is just the U.S. federal Treasury federal deficit as a percentage of GDP. So I need to scale it to relative to the size of the economy, and that's running around 7 to 8% of GDP right now, which is pretty high. I mean, it's a relatively high deficit, which means it's stimulating the economy, it's putting money into the economy, and particularly in terms of infrastructure and things like that. So the infrastructure bills, Infrastructure and Jobs Act, the CHIPS Act, the Inflation Reduction Act that we were passed in the last year or two, are all having their impact on the economy now over this last year or so. And we're seeing that particularly in a lot of industrials companies, a lot of technology companies, and to some degree consumer companies are all benefiting from that. All those factories being built, whether it's electric vehicle plants or fiber optics or roads and bridges, all those things are part of that sort of fiscal support, in addition to the fact that higher interest rates, because of the Fed, means that the federal government is paying out more in interest. All the people who own treasury bonds are getting more interest now than they used to. And that's an additional source of kind of stimulus for the economy in some ways. So there's a lot of those factors that are adding money to the economy, that are supporting activity, that are helping to counterbalance the reduced activity caused by higher mortgage rates, higher auto loan rates, higher credit card rates that are coming from all the tightening that the Fed has done. So to me, that's really the key factor, is the federal fiscal policy, the deficit, and the form that it's taking in the form of infrastructure spending in particular is really helping to support the economy and offset what would normally be, a slowdown caused by tighter monetary policy.
Mm-hmm. Do you think, do you expect a slowdown? Because, caused by tighter monetary policy. I get you point out the fiscal support. But do you expect a slowdown? And if so, when and what might that look like?
Yeah, I think it'll be kind of a gradual slowdown. I think that fiscal policy, we're seeing the effects of, policy that was already passed in the last year or two. But now that the politics have changed, I think there'll be much less of that, if any, going forward. So I don't think there'll be any big new programs or stimulus of things to really drive things like we've seen in the last year or two. So I think as these kind of existing programs have their effect or priced in and kind of slow down over the next, say, 6 to 12 months, we'll start to see that in the data. I think things like, say, student loan payments picking up again, and things like labor, strikes, as well as the impact of the government shutdown that might happen next week, which hopefully will be a short-term thing, but you never know. Those things can drag on sometimes, depending on the politics. Those are all going to be headwinds. And I still like to say the rest of the world is kind of slowing down as well, particularly China. And so I think those are going to be, net kind of headwinds for the economy. So I think it'll be a more of a gradual thing than a sudden falling off a cliff. But I think it will start to get back to sort of slower growth as we get into the middle of next year.
You mentioned the government shutdown. How are you thinking about that scenario? I imagine you're getting questions about it as well. Can you explain your thoughts there?
Right. Well, and it certainly has a lot of similarities to the debt ceiling showdown we had earlier this year, all the other government shutdowns we've had over the years. It's all, obviously political. there's not actually a lack of money at the federal levels to spend. It's just a matter of the politics and kind of stunts and things. So I think it will have a near-term effect. It could potentially throw off some of the economic data, both the actual activity and the collection of the data. If if the statistics bureaus get shut down for a while, it'll make it harder to actually collect the data. So it will muddy the waters for a little while. If it doesn't go on for too long, if it's a week or two, then that probably won't have much effect. If it goes on longer than that, then that will have more effect. But again, some of it is spending that will get delayed. Once it stops, the money that was going to be spent will probably be spent anyway. So it's not a big picture long-term trend, but it does kind of show you the noise and the volatility that's being caused by politics in the underlying economic activity.
Yeah. Another area you mentioned was inflation, and I want to hear more of your thoughts there, because we have seen energy prices go back up, but it sounds like you think inflation's kind of headed in the right direction. Can you explain your thought process there?
Sure, yeah. And again, that's another area where the data is very noisy. It's hard to get a clear read, certainly on the month-to-month data. But to me, the worst of the inflation really peaked around the middle of last year, July or so of 2022, after not only all the COVID impacts, but Russia's invasion of Ukraine had driven up commodity prices dramatically. That all kind of peaked around the middle of last year and has been generally slowing since then. Not that prices are falling, but that the rate of inflation has been coming down. And you see that most directly in commodity prices overall. And really recently, you mentioned oil prices has kind of diverged from the rest of the commodity kind of prices overall, including things like natural gas. And that's really being driven almost entirely by OPEC and Russia, restricting supply intentionally to drive up prices. And they've done several steps of that, trying to restrict output to raise prices. And they finally managed to get prices to go up some as a result of their supply restrictions. But most other commodities, whether it's copper and metals and things, or food prices, most of those are still kind of flat to lower recently. And so to me, it looks like most prices are still kind of stable or declining, and oil is kind of the outlier. And again, that's really just OPEC driving that. Output from the U.S. and from non-OPEC countries has actually been increasing and partly offsetting what OPEC has done. And to the extent that continues, then I think that the oil prices will eventually kind of normalize and come back down a bit again. So I don't think oil is going to be a long-term problem. I don't think 6 months or a year from now it's going to be a whole lot higher. I think it's more of a short-term issue, and I don't think it's indicative of a broad-based inflation problem. I think most prices for goods have still been coming down. Services are taking longer to come down, but that's where people are spending their money. After COVID started, everyone's bought goods and stopped buying services because they couldn't. And now they've kind of cut back on goods buying so much and going out to hotels, restaurants, concerts, all that kind of stuff. And that's where the money is being spent right now. And people have the money to spend from their labor income. It's not coming from excessive borrowing so much as it is from just their paychecks, which have been going up. So that's, to me, a more better, sustainable way for spending to be driven, and is less inflationary than if it was driven by credit, excessive credit. And that's what we're seeing, this cycle. So to me, the general trends are still towards slowing inflation. The housing costs that are embedded in the CPI that get a lot of attention, those are lagged by construction, meaning they tend to sort of reflect what's happened over the last 12 months, not what's happening right now. And so I think as that data catches up to where rents and home prices are right now, you'll see the inflation data continue to slow and to get closer to where the Fed really wants them to be, around kind of 2 to 2.5%.
Do you think we'll get there to 2.5%?
I think so. I think if you look at the CPI, excluding housing, excluding the shelter costs, everything else except for housing, it's actually already at 2.5%. Actually, it's a little bit below that. So except for the housing costs, which we know have a lag in them, inflation is already at or below the Fed's target. And actually the producer price index, which is the wholesale kind of business inflation measure, that's actually been close to zero lately. So it's actually already below 2% itself. So some of those kind of more leading measures that don't have the lags in them are already there, very close to or below where the Fed wants them to be. So in my mind, that tells me that it's really some of these lagged effects on housing and the kind of short-term volatility caused by oil that are really the only things that are holding up the overall inflation numbers. So in a lot of ways, inflation is already there. It's just not quite showing up in the data yet because the data has these lags in it. And the Fed, I think, knows that. A lot of people kind of are seeing that. And that's why when you look at the financial markets where you can actually bet on inflation, there's inflation swaps that institutions use to actually bet on the level of inflation, CPI inflation, over the next year or 2 years, 5 years, whatever you want. Those have all been hovering right around 2.5% recently. So the markets are not priced for more inflation. They're assuming that it will get back to that kind of 2.5% level pretty soon, based on what the data is already showing and what it's likely to show, given that we know that rents and things have already slowed down quite a bit from where they were, say, last year.
Got it. Okay. So also just like on the Fed, higher for longer, is that do you also, I guess, do you have that view as well, that we're higher for longer here?
I think so, yeah, at least certainly longer than what the bond market had been anticipating just even a few months ago. The bond market had been anticipating, quite a number of rate cuts, starting next year. And I think that they're having to price that out and say, well, maybe there won't be so many cuts or hardly any cuts. And then the Fed's adjustment last week at their meeting, they raised their own projection for their own policy rates for next year, I think from 4.6% at the end of 2024 to 5.1%, which is not really very far below where they are right now. So I think they're moving in that direction, assuming that the economy will actually avoid recession for a while, and that it will allow rates to stay higher for longer. Now, the Fed can be wrong too, and I think the market can get kind of move in either direction too far. I think you might get some rate cuts next year, but I think it'll be more a matter of bringing rates down to where a 2% inflation rate would be more consistent with. 5.5% is pretty high for policy rates if you think inflation is 2.5%. So I think 4 or something would be probably more plausible in terms of a real rate. But I think that it'll take a little while to get there in terms of the market sentiment. So I think we'll have to go through this period of kind of uncertainty about what the Fed's really going to do versus the way their kind of hawkish messaging is staying. I think they're very intent on making sure that their messaging stays hawkish and stays focused on inflation, even if their actual policy activity really won't do anything. Probably, I suspect they'll probably keep rates where they are for a number of months now before they do anything new. So I think it'll be kind of the message says one thing, but the actually activity says something else. I think that's what the market's having to adjust to now.
Yeah. Okay. So, and earlier in the conversation too, like you mentioned, like more of a gradual slowdown in the economy. Do you not see the recession scenario? I have like such a diversity of guests with different opinions. So I would love to hear your thoughts. Like, do you think we avoid a recession? Do you think we'll see one, not see one? Just curious your thoughts there.
Yeah, I'm not currently expecting a recession, certainly in the next, say, 6 to 12 months, kind of in the normal forecasting horizon. Obviously, eventually we'll have a recession someday. And I think most of the recessions that we're used to looking at over the last, say, 20 or 30 years have been driven by a combination of tighter monetary policy and tighter fiscal policy. That it's really those policy changes that drive the recession. And then there's some cases like 2008 where the regulatory backdrop and leverage and those kind of things were much worse than they are now. And so it made the recession worse than it otherwise would have been. But I think that we're probably going to avoid recession as long as fiscal policy has at least some supportive impact and can offset monetary policy, which is what we're seeing right now. I think that can continue for a little while longer. The risk really is that fiscal policy suddenly changes and becomes much tighter if Congress decides to really cut spending or raise taxes, things like that. That would then raise the odds of a recession coming more quickly. I think that the job market and the wage income and things like that will continue to gradually slow, but there's still a fairly tight labor market. I don't think that's going to change suddenly, and that's kind of where consumer spending really comes from. I think that's still pretty good. And so I don't think that there's going to be a reason for the economy to go into recession unless there's what I think of as a policy mistake, meaning that they over-tighten either fiscal policy or monetary policy and will either cause a banking problem or cause just sudden stop of fiscal support. So I don't see that right now, but it's certainly a risk, and certainly given what Congress is right now, that's probably the bigger risk that I see, going into next year.
Yeah. How about the consumer? You mentioned the consumer, and obviously tight labor markets. And what is your assessment of the strength of the consumer? Because that is such a critical part of GDP is the consumer.
Well, absolutely. Yeah. No, and I think that's been the key driver for both the U.S. and really the world, that the U.S. consumer is driving things and allowing other countries to, export to the U.S. and keep their own economies going. So I think it has been a combination of, kind of lack of labor supply post-COVID, from a combination of just the impact of COVID itself, limited immigration during and right after COVID, has meant that there's more competition for workers, and the companies are now having to sort of pay up a little bit more for labor relative to what they've done, pre-COVID. And so I think that's a good sign, and certainly the thing that all the strikes and kind of labor issues we've seen with auto workers or the writers and the actors in Hollywood, but even beyond that, a lot of other areas you're starting to see more unionization and more labor issues. And that's the direct result of the fact that there's not a surplus of labor like there used to be, and that employers are having to pay up to get labor and keep it. And so I think that's, we balanced the economy a little bit and given consumers and wage earners a little bit more to spend and a little more support relative to what we saw, pre-COVID. I think that's a good thing overall in the sense that it balances the economy. It might reduce income inequality a little bit. The economy tends to do better when there's, somewhat less inequality. When kind of the middle or lower incomes have more money to spend, it tends to get spent. And so that's generally better for economic activity. So I think that those are all kind of longer term structural factors that are still in favor of consumer spending and the employment market.
Yeah. Well, Sam, we've certainly covered the ground when it comes to the economic picture. Let's move into markets. I want to give you some time. We can also set the table here. We can have you kind of give your views, your big picture views. We can do like equity markets, fixed income, other asset classes. So let's start there.
Sure. Yeah. So I guess at the big picture level, I still prefer equities over fixed income. And then within the fixed income markets, I've been underweight bonds, meaning longer term, long duration bonds, and favoring cash, money market, short term T-bills, things like that. For a long time now. I think I actually went underweight bonds in late 2020 and have been progressively more so over the last year or two, just because both the way the economy's developed and the fact that interest rates were so low back then means that fixed income, particularly long duration fixed income, has been unattractive for some time, and it still is. Bonds are in a bear market by almost any measure, and really one of the worst ones they've been in for many years. So I think that's kind of been the backdrop of what people thought of as being safe, meaning treasury bonds from an actual return perspective, from an investment perspective, have not been. And so I think equities have outperformed bonds this year by a wide margin. And I think that may continue for a while longer until interest rates really get to the point where they've priced in all the things that the Fed is going to do and that earnings start to slow down. So I think that earnings are growing and that they've been better than expected over the last 2 or 3 quarters. So that tells me that equities have the tailwinds over fixed income. And in an inflationary environment and one where the economy is doing better than people expect, equities are really where you want to be. So I've been overweight equities and underweight bonds and really focused on things like technology, consumer and industrials as kind of the parts of the equity market that are seeing the strongest support and that are benefiting from the consumer and from the fiscal policy.
Got it. Well, okay. I have so many questions. Okay. On the fixed income side of things, I would love to just hear more on that. You're talking about being underweight bonds as of late 2020 and talking about like the long duration fixed income. Like I heard a bear market in there. And I've also heard people talk about like that we might be facing a duration crisis, maybe for And let's see, like maybe for folks who aren't necessarily expert or follow that space, can you just elaborate a bit more, like what is going on when it comes to fixed income?
Right. Well, and it's been a volatile and kind of confusing period here for really a few years now. And a lot of it, started, of course, with COVID, when the Federal Reserve, really got aggressively involved in the bond market to prevent all the disruptions from COVID, and pushed interest rates very, very low. And at that point, the idea of buying a long-term bond, a 10-year bond or a 30-year bond at a 1 or 1.5% interest rate, became very unattractive. Once you realize that the economy was not going to fall apart, that all the fiscal support, all the stimulus checks, and everything else that happened after COVID, and then after that, all the infrastructure spending and everything else, has meant that that the economy was not going to go into a recession, and that inflation was going to be higher for a little while, and it went up for quite a bit, and now it's coming back down again. Those are all things where you really don't want to own long-term bonds that pay low interest rates, and that's what you were faced with, back in 2020 and 2021. And in fact, that's actually what got a lot of the banks, the Silicon Valley Bank, and a lot of those regional banks that got into so much trouble earlier this year. That's what they did. They bought long-term treasury bonds in 2020 and 2021, and those were on their balance sheet. Those bonds have all fallen in price by 20, 30% in some cases. And so if you're a bank and you're, levered to some degree, those are big losses. And that's why some of them have had trouble. And if you're a bond investor, whether you're in a mutual fund or an individual investor, those are, very negative returns you're getting from bonds, even though most people think of bonds as being safe and maybe you don't make much, but you never really lose much. But if you own long-term bonds, you may be down 15 or 20% on those holdings over the last 2 or 3 years. And so that's a tough thing to look at if you're, thinking about a kind of a balanced portfolio between stocks and bonds. You think bonds will be the safe part, and they're not. And so that's why I think it's important to think about duration and fixed income, meaning if you're going to own a longer term bond, a 10-year bond or longer, you're taking more risk. Those bonds can really move around a lot in price if interest rates change. And that's what's happened. A bond that might have been priced at, $100, bond is now might be trading at 80. And so that's risk in some ways. It's almost like owning stocks over the last couple of years. And so it's really not as safe as you would have thought if interest rates are low and potentially going to go up. And that's what we're seeing. And we just didn't see that for a long time. It's been years and years since we've really seen interest rates go up like this. So most people had almost forgotten that could happen, and that the Fed would move as quickly and aggressively as they did to raise rates. That's been, again, at least since 2005 to 2007 was really the last time they tried to raise rates that fast. And it wasn't even as bad as this. So bonds do have risk if you own long-term bonds. And that's why, I've been saying that owning shorter-term bonds, maybe a 3-month bill or a 1-year, note or something like that, or money market funds, those are not going to lose you money, that to that degree. You're mostly just going to collect your interest, and that's all. Which again, over the long run, doesn't make you a lot of money, but it's much safer in the short term if you think rates might rise and the economy is not going to go into recession, which is what's happened here.
Got it. Okay. This is so interesting to me. So I love this show so much because I get to talk to experts like yourself and learn. Because so duration risk, like that's the interest rate sensitivity, and for about a decade, you had zero interest rate policy. So that really had not become an issue until you saw like the rate hikes, and not only that, but like the speed of those rate hikes. So does it matter? So I suppose, does this matter like when you bought those longer term bonds, like the 10-year or the 30-year? Does it matter when? Or like, what if you bought it today? Like what, maybe these are naive questions, but they are kind of just bubbling up for me, just curiosity. Like, I guess for the folks who bought in 2020, not so great. How about today? What does that look like? Or what would be the risk there?
No, you're right. It very much depends on when you would be buying the bonds. And if you bought them in 2020 or 2021, yeah, you're in rough shape now, in the sense that you're sitting on those kind of losses on the price of the bonds. Now, the treasury bonds, and eventually you'll get your money back. You're not going to default. It's just that, interest rates are much higher now. So the price of the bond you bought when interest rates were lower it's worth less right now. Now, if you're buying bonds today, you'll certainly get a much better deal. Today, the 10-year Treasury is yielding 4.5%, not 1.5%. So looking forward from today, you're in a much better place to buy a bond now than you would have been, say, 2-3 years ago. Now, that doesn't mean that if you buy a bond today, that if rates go from 4.5 to 5 or 5.5% over the next, say, 6 months or a year, you could still see, a little bit more loss on the price of your bonds for a little while. But that'll be a much less risk now than it would have been in the last couple of years. So definitely the risk has been reduced for bonds to buy them now in long duration. Like I said, I wouldn't tell a client to say, go put all your money into long duration bonds right now because they're such a great deal. But I think they're a much better deal now than they used to be. And so I think you're getting closer to the point where you might want to allocate more towards bonds. But I'm still underweight, kind of waiting for a better opportunity. I think there's the risk that because people have been selling bonds and rates have been going up for months now, there might be kind of that trend might continue for a little while longer, but maybe it's only a few more months before things start to shift. And I think if you start to see economic data get weaker than expected, come in lower than expected, then you start to see interest rates kind of top and the risk to bonds start to kind of really go down, and you might be more willing to be exposed to that long duration risk. But for now, you can get 5.5%, 5 to 5.5% in a money market fund for almost no risk. So for now, that's a safer bet. You can get a good yield and not have to take any real risk in the duration. And so that's kind of a better deal than long-term bonds would be right now. But maybe 6 months from now, that'll look different.
Yeah. Well, speaking of equity markets, the last time I saw you were bullish on equities. Can you kind of frame up and contextualize where you stand as relates to markets? Because we did see equities perform well in the first half of the year. And I know there was a lot of pessimism back in 2022. Just curious, where you stand today on equities and maybe more of the sentiment.
Yeah, that's right. And really for the stock market, that was really the big story of the last year or so was 2022. Almost everyone I talked to was expecting a recession this year, right now. Actually, I think we should be in a recession right now if they were, if that had played out. And they got really negative. They were seeing the Fed raise rates aggressively, and inflation was high, and fiscal policy in mid-2022 looked like it was tightening because all the COVID stimulus was going away. And they assumed, well, all the COVID stimulus is stopping and the Fed is tightening. That means recession's coming and earnings are going to fall apart. And so we got to be bearish, got to sell stocks. And that was their view, late last year and coming into this year. And then it turned out actually fiscal policy kind of turned around and became much more stimulative, and the economy did better than expected. And so everyone had to shift their sentiment from expecting, doom and gloom, recession coming, this year, saying, oh, well, maybe it'll be next year, or maybe, it keeps getting pushed out to when that recession is really going to hit. And so I think that's why stocks have done better this year, and even got through that kind of bank crisis problem we saw in March, that we thought, oh no, now the banks are going to fall apart. Well, a few of them did, but not all of them, and it wasn't systemic. And again, the Fed and the Treasury stepped in to prevent that. So we've kind of stepped over some of those hurdles that people thought were going to be a problem for the stock market. And now it looks like earnings are actually pretty good. Earnings estimates are rising. I do a lot of work about earnings estimates, and they're stable or higher. And not just in the big tech stocks that everyone focuses on, but a lot of companies are seeing their estimates stay the same or go up. And that's usually a good sign and tells you that the economic backdrop is favorable for corporate earnings, generally speaking. And that's, helping the stock market hold up, even though interest rates have gone up. And so to me, I think stocks can still outperform bonds for a while longer. I think we're now kind of consolidating some of those gains we saw back in, kind of May, June, July. But I think we have the potential for maybe the fourth quarter of this year to look a little better. Typically, that's when money comes into the market. So I think seasonally, that'll be better. And I think that's, a reason to stay overweight equities, at least for a little while longer, and kind of see how things develop.
It's interesting. Okay, so let's hear more on that. Q4 looking a little better from where you stand. Because are you as bullish as you were when I last talked to you in February, or is it just like stocks seem to be the place to be, like they'll outperform bonds, that kind of thing? And I would just want to elaborate a bit more on some of the drivers.
Yeah, probably not quite as bullish and excited as I was earlier in the year, just because then the sentiment extremes were so kind of dramatic. Everyone thought the world was going to end, and this was true actually in Europe as well, not just in the U.S. And then the world didn't end, and so then they've had to adjust. And now people are certainly more bullish and much less negative about things than they used to be, and that includes the Fed, frankly. So there's not as much kind of readjustment of sentiment to go than where we were, say, at the beginning of this year. But yeah, that doesn't mean necessarily it's now the time to sell stocks. I don't think people have gotten excessively optimistic. And that's really what you look for, is kind of that pendulum to swing from being excessively pessimistic, which we were, say, in January, February, to being excessively optimistic, which is probably where we were in early mid 2021. If you remember, after the Fed had cut rates and all the stimulus money was going out and everybody was very excited and the market had gone up a lot, then we could start to see real signs that there was too much optimism and people were had too high of expectations about the economy and the stock market. And that's when we started to really anticipate maybe things were not going to turn out that well. And so right now, I think things have kind of gotten back to kind of more normal expectations, not as bearish as they were, but not overly bullish. And so to me, as long as the underlying fundamentals are still pretty good, stocks can still do okay and do better than bonds. But yeah, you're right. It's probably not quite the dramatic, kind of extreme that we saw earlier in the year that would say that there's a lot of room to go for sentiment. Now there's probably a little less room to go, but still some.
Yeah. And you were also mentioning like parts of the market you want to be in. And I think I heard you say tech, still, consumers and industrials. Can you elaborate more on where you want to be? I don't know how specific you can get, but if you can, let's get specific.
Yeah, that's right. No, trying to, individual stocks, I tend not to want to pick too much just because different people have different, financial needs, but also things can change about the individual name sometimes. But the broad themes that I've been seeing have been, technology, industrials, and consumer areas have been where really the relative strength in the earnings have been. And that areas like, for instance, commodities and healthcare and some of the more defensive areas have been kind of lagging and just haven't kept up with the strength in some of those more cyclical areas. And so I think part of that reflects the infrastructure spending, the industrial areas in particular, machinery and building related things, anything related to manufacturing, those kind of things have had a lot of tailwinds. Home builders have held up way better than everybody expected to because most people don't want to sell their existing homes. They're willing to buy new homes. So the home builders are still building. And then technology, a lot of software services, and even some of the hardware makers are still doing well. AI, of course, is the big thing in technology still. And so I think there's a lot of companies who are focused on that and are spending money on it, and a lot of earnings there still. We're seeing earnings estimates, rising for a lot of those companies. And so that tells me that there's still a fundamental tailwind for them, even though some of the stocks have had big runs and might have gotten ahead of themselves, some of the really big cap, popular tech names. I think there's still a fair number of those that have good fundamentals that could be bought, on these kind of pullbacks where we see, stocks correct a little bit. Those are still areas that might have some upside going into the fourth quarter of this year or first quarter next year, because I think they've still that's where companies are looking to benefit from, new spending on efficiencies and things like that related to technology, and all that money coming from federal infrastructure spending is still flowing through the economy into the industrial side of things. And that's where I think there's still some pretty good support for earnings into those specific areas that are benefiting from either kind of AI related stuff or infrastructure. Yeah.
Well, speaking of, equities, and you favor equities over bonds, what do you think about the traditional 60-40? Is that dead? Is that a thing of the past?
No, I think that's still going to be kind of a benchmark for many investors. I think, if you think about the 60-40, what would be the alternative? It'd either be all stocks or all bonds or some other assets, which, probably aren't going to be necessarily applicable to most investors, whether it's, commodities or alternatives or real estate or something like that. So I think, to me, like I said, I've been overweight equities on a kind of a cyclical basis recently. So I've been, more than 60% equities, more like 75%, and underweight bonds. So maybe, instead of being 40% in fixed income, I've been 30 or 20. But the idea of a 60-40 as a benchmark, I think still makes sense longer term. But I think you really have to be able to, deviate from that at times on a cyclical basis to take advantage of, the dislocations or kind of distortions in the market. And that's what we've seen over the last few years was that interest rates were kind of, bonds became abnormally unattractive in 2020 and 2021. And then now have become, more attractive, but not too attractive yet. But you still have to have that 60-40 as kind of the benchmark to move around from. And so to me, I think there'll always be a room for bonds as kind of the ballast or the kind of the safe component, an income-oriented component of the portfolio. But at times, that's just not going to work well. And so certainly 2020, 2021 was one of those times. I think we're getting back to more normal times when you can get, a reasonable expected return from bonds and from stocks. And so something closer to 60-40 will look better. And actually the 60-40 portfolio has done better thanks to stocks. So over the last, say, 6 to 12 months, a typical 60-40 will show a positive return. But it's mostly because of the stock part of it has really, recovered well and not so much the bond portfolio lately.
Noted. Well, Sam, I'd say it's been great having you on. I want to give you a few moments if you want to let folks know more about the work that you all do at Mill Street Research. I know you all have an institutional focus, but I believe you all have a newsletter as well. And any parting thoughts, anything that didn't come up in this conversation around the economy or markets that you'd like to share, please take a moment to do so.
No, I appreciate that. Yeah, no, and certainly, millstreetresearch.com is the website. There's examples of the work. There's a blog on the website that gets updated periodically. And yeah, there's a report we put out called Weekly Roundup, which is more focused on, individual investors or maybe small investment advisors who want to get a feel for what the work I do looks like and kind of get some of the highlights of it from asset allocation we were talking about, as well as the stock selection work that I do. And so that's just, it's $50 a month. So it's much less expensive than the what institutional investors pay to get the work. That's on the website as well. And then on Twitter and on LinkedIn, I'll typically post comments about the macro outlook or sectors or stocks. So you're interested in kind of seeing how I look at things and examples of the work. You can follow Mill Street Research on both Twitter and on LinkedIn.
Well, Sam Burns, Chief Strategist of Mill Street Research, thank you so much for being so generous with your time and your ideas. Really appreciate you coming on.
Oh, it's been my pleasure. Thanks for having me on, Julia.
Thank you.